If you want to grab this link right now on the left, that is really helpful. So you'll be able to access that after the actual session. And if you want to learn more about our next workshop, that's supposed to be January 9th. Starting January 9th, 3-part workshop, completely free, all about the fundamentals of raising in 2023. All right, next, Mike, are you there? Love to know if Mike Gorback is in the audience.
I'm here.
Trying to come off mute and say, Mike, how are you, man? Are you,
good, man.
You're in the Bay Area, right?
In the Bay Area, yeah.
Amazing. Well, look, before you say anything, I did want to say, this is very coincidental that Mike hasn't even able to join us. But as I posted a little bit more about safes and my desire to do a workshop on the topic, Mike was jumping in, chiming, sort of giving expert opinions and feedback around the questions that were coming in the thread. And it was just very obvious that 1, he was an expert, 2, he's a big supporter of founders. And we thought it would be a great opportunity to partner and make sure that there's a real expert on the line in case you guys have the detailed questions that I know will probably stump me. Mike, if you have a second, would love for you to just share a little bit more about Hanson Bridgett so everyone knows the firm and can get in touch if they need help in the future.
Yeah, absolutely. I'd love to. And yeah, thanks again for having me. Super stoked to be here. Hanson Bridgett's about a 200 lawyer law firm. We've got offices throughout California, throughout the Bay Area, Sacramento, Los Angeles. We're going to be in Orange County very early in 2023. The corporate practice, we love working with startups sort of across various sectors. And one other thing that's really great about Hanson Bridgett is, we pride ourselves on our diversity and inclusion. So we've just elected our first female managing partner in our 60-year history. Super excited about that. We were a founding B Corp. For those of you who kind of understand, what the benefit corporations and B Corps, they're different. Happy that's a different workshop for a different day. But we're super excited that we were one of the first law firms to be a B Corp. And we just, we really pride ourselves on our various diversity and inclusion initiatives. So I love working with startups. I've been working with startups 20 years. Safes, I feel like I get questions about safes at least, 10 times a week. And so this is like a great opportunity to share some of the stuff that I've learned along the way. And I think it's really great, Jason, that you're putting this on because it's super, super important for folks to understand kind of the nuances when you're going to use these instruments. So yeah, I think it's great and happy to be here.
Awesome. Well, Michael, thanks so much for just spending some time and just being a resource to the community. And Michael touched on exactly what is important about this and we'll get into this, is that there's actually a lot of nuance in these vehicles, a lot of things that even people you would expect, venture capitalists included, who don't understand the dynamics of this. So I think what we're trying to get to is for everyone in this call to get to a higher level of understanding and really be able to manage these things as they come along. All right, I see Nancy in the audience. Good to see you, Nancy. Actually, I call out Nancy because I know she's been in my programs before and workshops. I see Raul as well, which means a lot of you have seen me give this part of the presentation. But for all the newcomers, I have to go through this baseline because it's really important in anything you do and see within startup education. First of all, I'm going to give my background. Worked in technology at MLB.com. I was a venture capitalist at Graycroft, then was a co-founder and CEO at a couple startups, including one called Tape, raised a couple $1 million, had a small exit in 2020 before transitioning over to this line of work, where I started off as Silicon Valley Bank's internal fundraising coach, and then went on to do my own thing, building this company called Adamant. We're focused on making fundraising easier and more accessible to as many founders as possible. And I do that mostly through content and education like this. I have a podcast. I have a lot of other things. This is a quick run through of my background, not because I'm trying to credential myself or that I'm trying to impress you all. What I'm trying to do is give you context for how I've come up with the advice that I'm going to give you, context for why I even say the things that I say. And I want you all to have context for my advice because I think context is incredibly important for any you get game and fundraising, because I think that you probably have noticed this in the past. Any topic worth giving advice on, you're liable to get two parties that are equally credible who will give you 180 degrees the exact opposite piece of advice. You've probably seen this before. And when you see that, I think it's really important to understand that context matters, that the advice that's given over Twitter, over blog posts and podcasts, these are sound bites, right? And so it's really incumbent upon you to dig a little deeper, to understand the context for which someone's giving you the advice, try to peel back and get to first principles. So that's my background, so that when you see advice that I give you, you kind of understand where it comes from. And a great example of this that I always share are these two messages. Really, this topic, as you read through it, is about data rooms and when founders should share data rooms with investors. It's a great illustrative side-by-side tweets. One is Andrea Funston, one of the managing directors at Basecamp Ventures. The other is Mark Suster, managing director at Upfront Ventures. And they're saying essentially the exact opposite pieces of advice. On the left, Andrea is saying, founders, one of the best things that I see is when a founder shares their data room immediately before we even get deep into a fundraise. They're sharing their data room. It's one of my favorite signals. And Mark Suster on the right is saying essentially that founders should almost never share a data room. And the thing about it is, these tweets, these headlines, these blog posts are completely opposite pieces of advice. But if you had these two investors break bread and talk about it, I bet you they would agree with a lot of the sort of first principles behind what data rooms are and why they should be shared. So this is a long way of saying, look, we're going to go over a lot of information here, but just listening to the top level advice is not going to be enough. You want to understand who's giving it to you, and you want to try to dig deeper so you better understand and can make your own decisions and apply them to your own fundraisers. Okay. The second thing, which is important to understand, it's a baseline that I always lean into whenever I'm teaching anything around fundraising, is this idea that investing, and by virtue of investing, fundraising is not science. Investing is not science when especially early stage investing, when a venture capitalist meets Ken and looks at their business. It's not looking at all the details. It's not looking at pieces of information, sending it into an algorithm and being like, deal or no deal. That's not the way it goes. Fundraising is not science. There's much more of an art, a feel to it. It's all about influence. It's all about psychology. And I think that's really important as we talk through everything from the sort of the standard fundamentals of safes, but then also thinking about how you apply the usage of safes to a fundraise, which is a very psychology-based game. Okay, so you all know what you're here to do. We're going to start thinking about and talking about safes in general, what a safe is, making sure that we understand the basics of safes. And then we're going to transition to the main focus of this, which is stacking safes as a strategy, understanding why that's even a strategy and whether or not this can be applied in 2023, because the market has been changing quite a bit. I did a run through of this with my colleague Jonathan earlier, and we realized that we had just so much content in here. So what we're going to try to do is cut out some of the things I initially want to cover to make sure we touch on the basics, and then get into the meat of it, get into more of a discussion so that everyone learns. All right. So why are we even talking about this? I wanted to share this bit of content that my friend Peter over at Carta was able to send over to us. So Carta has some of the best data out there around what is happening in the world of startups. Anything that they see on cap tables, they can extrapolate to pretty amazing amounts of data. And one of those is that 1/3 of companies are safe stacking. So the idea of safe stacking is raising multiple safes before an equity round. That's kind of how I would think about it. And I think what's important is that as people rush into this, like we said before, I don't think founders understand the implications of safe stacking. I don't think they understand that safe stacking looks very different today than it did in 2021 when the market was going crazy. And as an illustration of that, this is just completely coincidental. This morning, I got a text from a former tech executive, incredibly successful tech executive, very senior, very wealthy individual who's doing a startup, and literally texted me about safes. And he said, hey, I raised one safe on a post money cap of this. I'm about to do another one, and I don't understand how this is going to impact my ownership. And you would think that someone that sophisticated, having made hundreds of millions of dollars in his career, having done crazy amounts of investing on his own, would understand that. But the fact of the matter is, it's a nuanced and detailed vehicle that not everyone completely understands, and people will pay a price for that. And I know Mike has seen that in his career, so we'll talk a little bit more about that. So what I want to get to is a little bit more of an interactive point here. And again, I remind everyone that the people that will start engaging and raising their hands and talking to me are going to get the most out of this experience. So there are no real, there's nothing to lose in terms of engaging with me, whether or not you're wrong or right. Those people that learn the most are going to get the most out of this. So I want to put this out there, and this is going to be a bit of an illustration around what the baseline knowledge of this instrument is. So I kind of want to cover a bunch of these things and have open conversations. And when I call on someone, I'm not going to do a full cavity search here. It's just kind of like 30 seconds, 10-second answers here and there. I'll popcorn around, make sure other people have opportunities to engage. But let's do a high level, quick description. Does anyone know what a safe is? Like, who wants to kind of raise their hand digitally or otherwise? Quick on the draw, Catherine from Magpie. Catherine.
Hey, Jason, great to see you.
Good to see you. Tell me what you think a safe is.
It's a simple agreement for future equity created by Y Combinator to reduce the cost and time to get investment for early stage companies. It has a couple key components.
All right, I'm going to pause you there. Very good. So simple agreement for future equity created by YC back in 2014, and all the things she said were great. Make it simple, etc. Thank you, Catherine. Anyone else want to raise their hand and chime in to tell me, what does it mean to be a simple agreement for future equity? Kind of give me a little bit of color around what that means. Carlos, I see your hand. What do you mean? What does it mean?
Thank you, Jason.
Yeah.
In my words, it's very hard to get on the same page with your investors on how much your startup is worth. Mm-hmm. So it's basically a decision, a mutual decision, when we're saying, let's focus on this cap and let's make this convert at a later stage and not lose that much time in an initial stage, speaking about how much is the valuation.
Got it. So Carlos is making a distinction, I think, between what a full equity fundraise requires, a very specific and confirmed understanding of valuation, a lot of other decisions being made. So he's, again, leaning into the speed and quickness of it. We'll talk a little bit more about this understanding of like punting the valuation question and whether or not that, in my opinion, is actually happening. But let's transition now to a quick description on how a safe works. Does anyone, if the people with their hands raised are still good with this, I'm going to go with Jack Roosevelt. But tell me a little bit about how a safe works. What does an investor that invests in a safe get, and anything else you want to tell me about how the mechanics of that work? Jack.
So you're getting a structure that's similar to equity, that isn't actually a straight equity ownership piece, opposite to a convertible note where you're actually getting a debt instrument, and the company also has to pay interest on that, which dilutes them down even further. This actually gives you a simpler way of doing an equity piece without actually giving the tax implications to the owner and also the dilution side. And it's much more founder friendly than a note or including a straight equity raise, because you are, again, going back to the punting on the valuation.
Okay, so now we're getting into a little bit of this distinction, more of the legal definitions here. Mike, Mike, I wonder
And the
if
safe
you,
is actually the structure you receive.
yeah,
So
okay,
that is actually the instead of receiving a share, you receive an actual safe.
there you go. So Jack kind of cleared up a couple things. I wonder if anything, Mike, raised a little bit of alarm bells, like you want to make sure that you clarify something. You don't want people to have the wrong idea. Was there anything that Jack said that you want to like underline or slightly correct there
Sure.
around?
Yeah, I mean, so taking a step back though, right? Like, I think it's important to understand what safes did, which is that they essentially replaced the convertible note, which was
That's right.
really the standard of practice in Silicon Valley for 20 years, right before the safes came out. And what the convertible notes were doing is they were a way for startups to essentially bring money in the door. And you sort of alluded to this already, right? Which is the idea of punting valuation until a later point where maybe both parties have a little bit more data on which to really arrive at a reasonable valuation. But the idea behind convertible notes was you go out, you raise the money now with the idea that the notes will convert later in your equity round, usually at a discounted price, right? And the discount could be as a result of either a percentage discount or a valuation cap. They were always done on a pre-money basis. And what happened was around 2014, YC, with contributions from a guy named Yoakum Taku at Wilson Sonsini, my old firm, decided, hey, we can get rid of some of the things that startups don't like about convertible notes, like a maturity date, which can sometimes lead to investors sort of holding those maturity dates over the company as leverage for negotiating more favorable terms than what they previously had, as well as the interest, which the last speaker just alluded to. We can eliminate that stuff by creating this sort of hybrid debt equity instrument called the SAFE, which is just going to take the place, right? And sort of get rid of the nuances and negotiating various points of convertible notes. Convertible notes usually involve sort of a more complicated legal process, including a purchase agreement and then the form of note, which were all sort of heavily negotiated, which means more legal fees, right? And so that's kind of like where the SAFE came from. And, but I agree. I mean, generally it serves the same purpose basically, which is it allows the companies to raise money today without going through the process of actually doing an equity round, which can be expensive and involves lots of different negotiated agreements and so on. And but Jason, when you're ready to start talking about whether you're still punting, because we used to talk about like, hey, one of the great things about convertible notes back in the day, or even like the pre-money safes when they came out, is we can actually do that, right? Like it may be too early for a company to really know what a reasonable valuation is, right? You just launched, you're trying to raise a seed round, or at that point it was usually just straight to Series A, and you have no idea, right? You don't want to screw yourself as the company by going with a valuation that's too low before you have enough data to support it, nor did you want to scare off investors by aiming for a valuation that was unreasonably high. And so you could bring in this investment, actually put off the discussion of valuation until later, and everyone would agree with it. But now that we've got the post-money safes, right? I mean, that's not really what we're doing anymore. Now you really are having to determine what that valuation is. And so we're sort of, we've defeated that early purpose of that the convertible notes served so well for founders.
Yeah. So we're going to get into some of that, and we'll talk a little bit about what the perception of caps are. I think that is what we're getting at. I honestly believe whether it's pre-money or post-money caps, while the intention was a certain way of punting these decisions, the market is accepting these caps as essentially valuations, and they affect the way people fundraise in the future. So we all have to be aware of these things. Before we go on, so this was a great little quick primer on what safes are. Hopefully the people that knew less about it were able to pick up some of these details. Quickly in the chat, I want you guys to throw in what you think the top 3 components of a safe, little aspects or details of a safe that people need to understand as they go into setting up a safe, investing in a safe, et cetera. So throw in 1 to 3 things that you think are important. So we see pre versus post, valuation cap, discounts. Yep. Okay. I don't see anyone missing the answer. This seems a little bit too easy. But yes, here is the answer. I think the three most important things people need to understand are valuation caps, discounts, and the difference between pre and post money. Now, I would say that if these three things, 90% of founders that I talk to know what these three things are to about an 80% level, meaning like they kind of understand the feel. And if you're going into a conversation with your founder buddies or investors, you directly understand what's going on. But when I ask people and I put them on the spot to teach me how this works, how does a cap actually work? How does a discount actually work? I think, unfortunately, most founders will be able to directionally describe it, but not get me all the way there. And as I'm like discussing this, I could ask you all, I could ask Sakiko to tell me, how does a discount work and when does it work? I could ask Jamie, what is a cap and how does it work? But I'm not going to do that. I'd rather you guys kind of pretend like I asked the question, run through your head. How would you answer that question? And in your heart of hearts, do you understand what a cap is, what a discount is, when it's operational, when it comes into effect? Start thinking about that. And instead, I will show you a quick diagram that I think is important, and I'll tell you what these terms mean to me, and then I'll let Mike correct me, as I'm sure I'll miss some of the details. So a valuation cap and a discount both have the same goal in mind, which is to help calculate how much ownership a safe investor actually owns once the equity round comes into play. So again, when you invest in a safe, it technically hasn't become equity yet. It doesn't turn into equity until the next equity round happens. At the time that the equity round valuation is set, that's when some of these triggers come into play, and the investor then is able to calculate exactly what they own. One thing is called the valuation cap, and the other is called the discount. So in a valuation cap scenario, what it's saying is, if I say I'm investing in something that is at a $10 million post-money cap, it means that no matter what the equity round valuation gets raised, it could never be, my conversion could never be higher than this valuation cap, essentially. Like, I am never going to be converting into an ownership that is higher than calculated off of this valuation cap. A discount is saying that I can never be converted at a rate that is worse than the discount to a valuation. I'm kind of like jumbling my words here, but what you need to completely understand is when a discount comes into play and when a valuation cap comes into play. I think that is the simplest way to think about it. A discount comes into play when the equity round valuation is actually less than where the valuation cap was. So if I set a valuation cap at $10 million, people invested in that, and the next equity round actually came in lower than that. Someone said, no, you're not worth $10 million, you're worth $5 million. And anything below that valuation cap, the discount comes into play. So I don't pay at the $5 million, I pay at a discount to the $5 million. Now, anything above that valuation cap, so if the valuation cap was at $10 million, and we were able to raise our next round at $100 million, the safe holder doesn't convert at $100 million equity valuation, it converts at the valuation cap. So those are the two components that I think are really important in safes. They help you think about why they even exist. And the thing that I'll describe, which is pretty interesting to know in today's market, is that for the last 2-3 years, I would say all the downside scenario components of a safe, like a discount, were never really thought about. In fact, they were like, oh, we don't even need to throw in a discount because like valuations never go down. Like in 2021, everyone was like, valuations never go down. Sometimes you would see zero discounts. And now what's happening is these safes that were raised at crazy high caps are now coming into play where people don't believe that they're worth that anymore. And so like either down rounds happen or companies die. Mike, anything that I missed? Anything that you want to sort of clarify for the audience around the components of a safe?
Yeah, no, I mean, that's exactly right. The one sort of nuance to what you said that I might point out is that it's possible that your discount would come into play even if the ultimate valuation of the price round is at or slightly higher than the valuation cap.
That's right.
The reason being that if your discount would take you, further below. I mean, the idea is that you get one or the other, right? You don't get a discount and a valuation cap. You get whatever is going to result in the lowest conversion price on your investment. So, it's possible if you have a $10 million cap, but the round is, priced at 10,200,000, right? You're not going to want your $10 million cap. You're going to want the 10% discount, right? Because that's going to result in the lower conversion price. But generally speaking, this is exactly right.
Very good. I love that nuance because that's true. And when you're a venture capital associate, you do a lot of these calculations where there is this like middle point where the valuation is a little bit higher than the valuation cap, but the discount comes into play. These are all theoreticals, but these theoretical situations, understanding those actually shows that you deeply understand how these mechanics work. Okay. So spend some time afterwards thinking about this. We'll send out some of these diagrams so you can think more deeply and discuss this with your future investors. So we talked about valuation cap. We talked about discount. The third thing that people were throwing in, which I deeply believe is one of the more important things to understand, is the difference between a pre-money cap and a post-money cap safe. The first thing to note is exactly how these things get calculated. And I think that's like kind of an easier understanding, like what does pre-money cap mean? What does post-money cap mean? We're essentially talking about where do we price the current valuation of the company, what we believe the company is worth. So a pre-money cap of $3 million in this example is saying today, before any money comes in, what do we believe the value of the company is? A post-money cap of 5 says, well, if I raise $1 million, then I'm saying essentially that the company today is kind of worth $4 million. And if I raise 2 million, it's $3 million. Here's one thing that I think is really important to understand about pre-money caps and post-money caps. I have a bone to pick with post-money caps. If you've seen any of the materials that I put out, I think in the right situation, both work just fine. But what founders don't realize is that if you set a post-money cap with an investor, every additional dollar you raise in this specific round essentially is diluting you more. It is saying that your company is worth less effectively if you think about the math. So this is one thing that founders need to be really careful about when they set things with investors. If you set a post-money cap and you say, I'm going to raise $1.5 million at a $5 million post-money cap, the investor has every incentive to encourage you to raise more money. On the margins, there's probably some things that they don't want to over dilute you, but they know that if we set a post-money cap, the more you raise doesn't mean they'll be diluted. They just keep, the sort of the effective pre-money of your company just keeps going down and down and down as you raise more and more and more on that same safe. Okay. So that's the pre-money versus post-money cap. I want to walk through a few positives overall of safes. I think a lot of people talked about this. They're simple, they're quick, they're standardized, they're trusted. I used to have a history slide here. We need to cut it out to save time, but yes, convertible notes in the past got you a lot of these things, but they were not standardized. They had different elements to them, so you weren't sure what you were signing, and they were not so simple. They included things like interest payments and maturity dates. Safes are great around all these things: simple, quick, standardized, and trusted. There are pitfalls and gotchas, though, that I want to make sure you guys realize, which is this idea of understanding caps, post-money and pre-money. A lot of people don't understand the dynamics around a post-money cap and how more money affects you. Calculating equity depending on how on top of things you are. This always felt silly to me as a former investor and someone that always thinks about ownership and cap tables, but I know a lot of founders don't do this, is that if you raise a bunch of money on a safe, technically, if you look at your cap table, you still own 100% of the company. Because like, I guess that safe didn't convert right now. It doesn't mean it's equity. But what you run into a lot is that founders aren't constantly updating. Every time they take $1 in, they consider it at the amount that is going to convert and say like, actually, when this converts, I don't own this amount of my company. So continuously updating your cap table understanding of where you think it's going to be so that you don't make the wrong decisions around what ownership you give away in a different round, about how aggressive you are with different things. But that's another pitfall for me. And then overall impacts of dilution, I think in general are really important. Here's one thing I'll put out there. I'm going to die on this hill, and I'd actually be curious what Mike thinks about it. But if you are going to raise money on a safe and you believe you have any amount of like influence to actually get the round done, meaning you don't have a gun to your head, you don't feel like there's no way you could influence someone to like invest in you, I would want everyone's first safe to be a pre-money cap safe. I don't know if Mike agrees with that, but here's the takeaway. And this presentation and workshop was not meant to be a discussion of this. We're going to get to the strategy of stacking safes, but post-money cap safes have anti-dilution in them. They don't describe it like that, but post-money cap safes have anti-dilution in them so that every security, so that they are not diluted by every security that comes after them until an equity round comes into play. So for your first round, if you're doing an angel army, if you're doing, if you're able to raise a small amount of money, if that first safe can be a pre-money safe, you're going to be doing yourself a favor in terms of future dilution. Of course, as you get to talking to other investors, people that might have more influence around what you do, they might say, no, I want to see it a post-money safe, in which case you might not be able to push for that. But in your first safe, please think about raising on a pre-money safe. Mike, do you want to push back on that?
No, so I totally agree that as between a pre-money and a post-money, if you can get away with raising on a pre-money first, by far the better choice. However, I'll just kind of say that you really have your choice in terms of which form of safe to use. I would like to see you raise on a discount with no cap, right?
Interesting.
If you can get it, because then what you're doing is you're letting the valuation, the conversion valuation on those safes just rise with whatever valuation you're able to ultimately negotiate in your round. So it could be, you could raise your first $1 million, $2 million on a safe, no cap, right? Just a discount, because your investors want something, right? You're not going to get away, at least with sophisticated investors, in raising without a cap or a discount. But if you can raise that first couple $1 million on a safe with just a discount, and then you're ultimately able to go out and raise, let's say your first equity round at a $30 million valuation, and you issued your safes at a 10% discount, which is reasonable.
Yeah.
Those safes are going to convert at a $27 million valuation. Whereas if you had gone with sort of a standard, expected market cap, you might have gone with the $10 million cap or something like that. And you're going to be
so Mike,
right.
That is one thing I'll actually push back on. So in general, you're right. Like I agree with one thing, which is like, if you're able to get an uncapped safe with a discount, then as the founder, you win because likely you will have your investors convert at a higher valuation than you would have if you just set a cap. Right. That said, I used to be an investor. I'm very founder friendly, but I understand what it means to be an investor. I understand what it means to like have them run their business. And you're not, in my belief, you're not trying to like overly maximize anything. Otherwise somebody is losing, and you're kind of, I guarantee you, because I was involved in a couple financings where we invested in uncapped at the time note, and they stacked notes, and then their first equity round was done at $100 million, in which case we're like, the investor didn't get compensated for the risks that they took on. And I will say too, in your very first safe or friends and family round, especially, like those people are taking the biggest risk in your company. And especially if they actually are friends and family, you don't want to take them for a ride. That's my opinion. I think you want to price it fairly for the people that are coming in, and like give them the ownership they deserve and then move on. But
no, for sure. I mean, great points. You're not looking to, take advantage of anybody, especially if it's friends and family. And, and besides, there are funds who won't invest in uncapped notes or safes, period.
Yeah.
Right. And so I think it is fact specific, but you're right. If we're going to rule out the uncapped safe, then I for sure agree that going with pre-money is going to be better for the founders.
Cool. And look, I think there are a lot of details to think through here, and we're just trying to get to the best answer for everyone, in my opinion. Okay, so that's the background. We're gonna jump into the idea of stacking safes. Now, I already can tell we're running a little bit behind schedule, but I want to tell you what my history, so that you have context for what I'm about to describe, because there are a lot of people that have different opinions here. My history around stack safes is that pre-2020, whenever I saw anything that looked like this, I was not a fan. I was like, this is not going to work. I felt like something was being pulled on me. I don't love the idea of valuations rising, even though like not much has happened as an investor. Between 2020 and 2022, a lot of things changed. I actually changed my own tune where I was like, I think anyone can access this strategy. And now we're in a very different world. So things have changed. I'll tell you where this evolution has drawn from. If you look at this graph, it really has to do with investor power within the fundraising process. Pre-2020, I think most of the power sat in the hands of investors. Founders had to kind of bend to the standards that investors were setting out there. But that kind of changed in this bull run of 2020 to 2022. You saw crazy amounts of funding going in, valuations going up, liquidity opportunities because of crypto and Web3 in a very short amount of time. And so essentially the power started going back into the founders' hands. They had much more opportunity to dictate what was happening. A founder named Sam Korkos, I think that I interviewed on Funded, was one of the main people to kick off the strategy of stack safes and do it very aggressively. Small tranches of 250K, just raising valuations, raising caps, to the point where everyone was doing it. Now, today, things are kind of different and unknown, which is what we're going to discuss in the future. So let's talk some about some of the benefits, which I'll touch on around fundraising strategy in general. The idea of stack safes, when people describe it, is this essentially a chopping up of the round that you want to raise. So let's say you wanted to raise $2 million, and saying you'll raise your initial tranche on 250K, you'll set the cap, you'll let it fill up. As it fills up, you'll go to the next cap and say, oh, that one's filled. We're at our next 250K. The cap is higher. And do that until you get to one, filling out your round, and two, a valuation where people are, not ready to go to a higher valuation cap. Now, the benefits of that are that you create a lot of momentum because each tranche only has a certain amount of capacity in it. There's built-in scarcity and this idea of price discovery, where you don't know what the market is willing to pay until you keep changing the price and see where supply equals demand. So like I said, I think this was kicked off by Sam Korkos. There's a crazy episode on this, on how he did it and how he calculated it. But what is more important is understanding where we are today. So today is different. I think you guys know what has happened in the market and in the world over the last year. Everything from global wars to different types of market crashes, public market crashing, crypto markets crashing, people being wiped out by different crypto exchanges, which even outside the crypto world is affecting the way investors behave because their bags got hit too, right? So we have FUD, we have fear, uncertainty, and doubt. We have investors taking their time to diligence companies, which sounds like a crazy thing if your only exposure to startups investing in fundraising has been 2020 to 2022. Gone are the days of meeting a founder, meeting an investor on a Friday, taking the weekend and getting a term sheet on Monday. That's not happening anymore. And then lastly, there's just tons of inertia. People are taking their time. They don't want to be pushed around the way founders were able to do so in the past. Okay. And what you should know is that there are mixed emotions around this. A friend of mine, Elizabeth Yin from Hustle Fund, is doubling down on this. She thinks this strategy is incredibly important, even in a down round, that you should be tranching your fundraisers. And I was quick to point out that I was, nervous about it. I was uncomfortable with founders executing this strategy. And so actually these discussions have made me sharpen my pencil around this. And what I want to do is talk you through what I think is the right understanding of using multiple safes in the most strategic way in the market that we're in today. In a market that is quite different from 2020 and 2021, where there was irrational exuberance. There was tons of fear, not of going to zero, but of missing out on a deal. Investors would see these markups going on and people getting liquidity after a year of investing and being like, well, Nick just came to me with this investment opportunity. I can't miss this. I gotta YOLO into this deal. That's what was happening before. And we're just not in that state of a market anymore. So how do we approach using multiple safes in a strategic but sort of measured way? Well, the thing that I'll tell you is that regardless of strategy, regardless of market, I think there are three things that are really important when it comes to any formula for fundraising. And that is finding a lead domino. Essentially, what is the thing that you're going to be able to hang your hat on to kick off your initial fundraising process. We're going to talk about momentum, which is keeping a process going so that investors feel the need to continue engaging. And then scarcity. I say this in a lot of different ways about investor poker, about this idea of always waiting to see the next card. But if an investor feels like a deal is not in scarce supply, that they always have access to it, then they'll really never have the motivation to make a move. I'd like to do this with a volunteer, but there's essentially a formula for doing this that I want you guys to run through and understand. But it has to do with these steps of planning your raise, identifying your lead domino, thinking about an angel army, kicking off your main raise, and then maybe oversubscribing. This is the only way I think that stacking safes as a full strategy works today. So what I'd love to do is have people raise their hands where they will tell me about a raise that they're considering going through, and we'll talk about how I would think through structuring this raise. Okay, Fer from Avioneta, do you mind coming off of?
Hey, how's it going, Jason?
Good. Where in the world are you, man?
Monterrey, Mexico. Mi casa es su casa, 400 plus participants.
Bueno. Okay, so tell me a little bit about how much you intend to raise. How much do you want to raise, and what stage of company are you in?
500K pre-seed. We have between 2 and 3K per month of revenue. We're shooting for 20.
I actually don't even want to know about your company, because I only want to think about the mechanics of the fundraise. 500K. Why are you raising 500K? Why is it 500? Why isn't it $1 million? Why is it not $250,000?
A little bit of pro forma planning for 18 months, looking at the gross burn rate and going like this and advising myself with some people.
Okay. Good honesty. And this is one of the things I think founders miss immediately, right? doing an initial plan for why you're raising a certain amount of money is really important for a couple of reasons. One, I think that is actually how you should be operating a business and thinking about your fundraise. But two, this is going to come up in discussions with investors because without going into too much detail, I think when you think about jumping on a venture capital treadmill, you are signing up to be a venture-backed company, a company that invests money before revenue, before profitable revenue, a lot of times, especially at the pre-seed raise. And so the understanding of getting on this treadmill is that 500K is not going to last you forever. It's going to last you to the point where you can raise your next round. And just saying 18 months is completely made up and finger in the air. I think you're going to need, I'd want you to get to a point where you understand, like, look, what I'm trying to prove to the market is 1, we can hire this team, 2, we can release this product, and 3, we can get our next customer. I just made that up. That's not for everyone, but you need to have a much more dialed in understanding of why you need this money, right? Okay, so 500K, let's assume that you have the answers for planning your raise and why, why it's 500K. So the next question I'd ask you is, like, what do you think your lead domino is? As in, what's the thing that makes you exciting today, not the future, but today as an investment opportunity?
As it pertains to investors, or what we're doing, like the business itself?
They're very similar, but yeah, to an investor, what do you think is the shiniest part of your opportunity?
Blue ocean in Latin America in this category, like first player, first mover in Latin America.
Okay, so it's story. That's fine. Just so you know, I think a lead domino can be a number of things. One of them is story. One of them is just, look, we are going after something crazy. Let me tell you this story about this amazing opportunity. And that's the domino that you'll use to start knocking over the next investors. But everyone should take inventory of what they have access to. Do you or do other founders here have a crazy network? Is your best friend already like somebody who's going to put millions of dollars or like $5,000 in and is a known quantity? It's like, oh, the founder, Patrick Collison, is my buddy. He's going to put in 5K. That can be a credibility domino, right? Like if you go to the next person and say, like, hey, I've got this company, Patrick Collison just committed and put money in. That's a domino. Is your traction a domino? Like you already have 2K of revenue without having raised a single dime. That can be part of your lead domino. But what I'd want everyone to understand is you need a lead domino. You need to understand what your lead domino is so you can start pushing on momentum. Okay. The next thing I'd say is you're going to raise 500K. 500K is already kind of an angel round, but I guess maybe in LATAM, funds will, participate in 500K rounds. I think you still have the opportunity to raise what I would call an angel army, which means thinking about maybe raising 100K just from angels, where the goal is to actually not get operational capital, but strategic capital on your cap table. That means like the 100K, yes, will be nice to spend a little bit, but your goal is actually to get people with great network, with great credibility and momentum on your cap table. So the angel army approach would be to say, okay, who do I know that I can start talking to? Give them a great deal. Tell them that you're just going to raise 100K before going out to raise 500K, and that you want them in on this opportunity early, which creates scarcity, which creates momentum, which then adds more network to your fundraise. So that's the angel army. And then you'll have essentially a 500K round that you're going to raise after that. When I think about safes and stacking safes after that, right now, I don't think it's smart to say, I'm going to chop this up into 150K slugs, first 150K at this cap. When that's filled, it's going to go up. Next cap, it's going to go up, because I just don't think the market will withstand that kind of gamesmanship. In particular, investors aren't like super aggressive right now and excited to invest. So any kind of like anything that feels uncomfortable right now, I believe will make an investor go, look, I don't need this. Like, I don't really need to engage in this right now. I'm sure, Farrah, you're going to be able to raise this with stack safe. I'm just going to bow out. Like, I'd rather just have something that I understand and be simple about it. Like, I'm not trying to get played here. I just want to know what the valuation is. So when you guys go into your main raise, the main part of that strategy, I would say, like, at 500K, let's say I know exactly how much I could raise, like let's say 450K. If I raised 450K, I'd be comfortable with there. But like, I'm also excited to like grow it to 600 and 650K. I would identify a very specific amount that you're going to raise, not chop it up where, like, if you didn't raise the next tranche, you would be shit out of luck. So in your case, Farrah, it would be something like 400, 450K. And then figure out what a fair valuation cap is going to be. And that can be set with an effective lead. A lead means a lot of different things in a pre-seed context. But I would find investors who want to write a bigger check. I'd find influential smaller check writers. Or the last option is that if a lot of people that you're talking to are saying they're kind of interested, then you can talk to them all at once and say, look, some people think that a 5 cap is fair. Do you guys think that's fair? And if multiple people say, like, I think that's fair, then you go set the cap. It's fair for everyone. And you try to raise that full 80%. And then the last step is, if you are filling that up, if you are getting to the 80%, you then have an opportunity to oversubscribe. An oversubscription can happen 2 ways. It can be, and I'll go to this. It can be oversubscription as in, hey, we said we were only going to raise 450K, but there's a lot more demand. We're going to open this up and allow people to keep coming in all the way up to 600K. So people then rush in at the end. They're like, oh, there's not enough room. There's scarcity. They fill out that last bit. Or if you feel like there's a ton of excitement around your deal, then maybe you can say, look, we didn't want to raise more than 450K, but there's so much more demand. We're going to open up one more safe at a slightly higher cap at, for another 200K. That's a little bit of the stack safe strategy, where then you're able to play the game of increasing valuation cap in order to minimize dilution. But that's an optional like card that you play, and only if you see the momentum around the raise going really, really strong. Okay. So that is, look, we are running out of time here. I will send these documents around. This is stuff that we talked about planning a raise, identifying the lead domino, the angel army, your one major safe, and oversubscription. But I'll tell you, this is only one component of the full fundraise toolbox that you need. We'll talk a little bit more in January about things like calendar density, the strategies to make sure you pack your top of funnel and you run a real process. But that's kind of it. Let me just put this up there. This will be the 3-part workshop we'll be doing in January of how to raise, going through the fundamentals. 3 parts, as in January 9th, 11th, and 13th. We'll send this up as a follow-on. Recordings will go out. Of course, you guys will get all of this. And I'm sorry that we didn't schedule more time for this. We should have done 90 minutes. Mike, thank you so much for showing up.
Absolutely, man. This was awesome. And I agree. This could easily be like a 3-hour discussion by itself. So it's good we got to do this though.
This was meant to be a tease. We have some threads going on in social media that I think Mike and I will chime in to try to answer some of these questions. So whether or not you're in Twitter or LinkedIn, find those threads, add the questions to them. We'll try to answer them over the next couple of days. Would love for you guys to listen to my podcast, Funded. Follow me on social, where I do a lot of this kind of free sharing. But thank you so much for joining. I know this was a packed session, but we will see you guys in the near. Oh, and please take the last week off if you can. Take some time to your family and friends. That last little bit will not be the difference between success and failure, and it might make you burn out. So relax. Have a great holiday, guys.
Thanks.